And we're back with another epic accounting video on a Friday night, but it's okay. I do it for you guys because you're awesome and you deserve it. And I forgot just how long and complicated it is to make these things. So we are going to be talking about notes receivable now. So accounts receivable and notes receivable, in principle, they accomplish pretty much the same thing in that they're both payments made on a delayed schedule. There are three main differences between accounts receivable and notes receivable. And those differences lie in terms of the time difference between when the promise is made and when the promise is actually carried out. The amount that is to be paid once the promise is carried out, and how the actual promise is carried out. And I guess four, actually, because it's also what happens when we dispose of notes receivable. So yeah, they're pretty damn different. So a note receivable involves a formal written promise to receive a set amount of money at a specific date. Now, these are called promissory notes. We don't talk about them too much just because they're not really used outside of business-to-business operations. I mean, you can write a note receivable to a person. You know, it just doesn't happen too often. But anyway, another thing, the second way that these differ is that interest is often added to these. So normally with accounts receivable, usually the payment is to be made within 30 days, and the payment is the original amount, and that's it. With notes receivable, interest is usually tacked on. And yeah, the formal written promise, so it is a legally binding document. I said that it's called a promissory note. The maker of the note is the person who promises to pay. And I mean, they're the ones who write out the document, so it makes sense that they're called the maker of the note. Payee is the person who receives the payment. And notes are issued usually when a customer wants to extend a date of payment. Also, you know, when they need product now, but they don't want to have to pay for it, or they can't pay for it within the 30-day period. So they either use notes receivable to extend a current accounts receivable time limit, or they use it just to delay payment to the point where they believe they can make that payment, except with additional funds, which would be represented by the interest. Whoops. Yeah, and like I said, most notes transactions are done between businesses. It's not usually something that one person does for another. I mean, it happens. It's just rare. So interest calculation, this is pretty basic. It's the same manner that you use to account for loans payable, in the sense that our interest is equal to the principal amount. I think I wrote these out. Yeah, I did. There we go. So interest is equal to the principal amount of the loan, i.e. the amount that's being borrowed, times the annual interest rate. The R is always the annual interest rate, so 6% per annum or whatever. And then T is the time outstanding in terms of a year. So I think I have an example here. Oh, no, I don't. Okay, I'm sure I have one at some point. But anyway, just to give you a verbal example, what would happen is, let's say you're paying, let's say you took out a loan for $5,000 at an interest of 10% per year. So what would happen is the interest amount would be equal to $5,000, the principal amount, times 10% times whatever fraction of the year the time works out to. That didn't come out very well. But I mean, for example, let's say that you promise to pay this 6 months down the line, and the annual interest rate, or R, is 10% per year. So in this case, the interest amount in dollars would be $5,000 for P, times 10% per year, which is the R, times 0.5, or 1/2, because it's half a year. The interest rate is in terms of years, so the time outstanding would be whatever the amount of time that the loan is going on for is. Or whatever, I should say, whatever the time left is. Or the time that's been used up. It really depends on the purpose of this calculation, so keep an eye out for that. Okay, moving on. Accounting issues for notes receivable. Oops. So in terms of accounting issues, we need to look at recognition, valuation, and disposal. I think I said that earlier. In terms of recognizing it, the first instance includes when accounts receivable is converted to notes receivable. And this is done in one of the scenarios I explained at the beginning of the video, where people want to delay the time period in which they have to pay someone back. So if you originally pay something with an account receivable and you can't make those 30 days, then you would talk to the company that you owe money to, say, look, I can't pay it, but I'll pay it to you in 3 months at 5% per year or whatever. And you would write all this out. And if the other business agrees, then the person who wants to change this to notes receivable would then draft out that document. So they would be the maker. So notes receivable is an asset. It's an asset account, and it's usually a current asset account unless, you guys guess, it's a current asset unless the loan time is longer than a year. So because it's an asset, we debit notes receivable by the amount of whatever the loan is, and we credit accounts receivable because we are transferring the amount from accounts receivable to notes receivable. So because we're transferring the money out, we don't have that asset of the accounts receivable anymore because it's been transferred to notes receivable. Oh, yawn, I'm getting tired. Okay. Businesses lend money to another party. So in this case, if you're the lender, this entry is made from the point of view of the lender. So in this case, you'd be creating a notes receivable, which is an asset, and you're giving them a loan of cash. So you're losing cash, so you're crediting cash. Okay, important point. Dun dun dun. At this time, the note receivable is recorded at its principal value. No interest is recorded. So interest is earned over time. You guys know that. And so at the time of issuing the note, no time has passed yet, so we don't get any interest at that point. Interest is then usually added on by adjusting entries depending on what period you're in. And then when the note is paid back or defaulted, we deal with interest again. So valuation. It's a similar procedure to what we use to evaluating accounts receivable. We estimate bad debts and the net realizable value of the notes receivable. And the only difference is that the allowance is called the allowance for doubtful notes. So we keep our notes receivable and our accounts receivable separate, mainly because of the timeline, because accounts receivables are all due within the same 30-day period, and notes receivables can be flexible, right? It could be 2 months, 3 months, a year, whatever. So we keep them separate. Disposing of notes. So this occurs when a note is received in full, i.e. the principal plus the interest at maturity. So when I say at maturity, I mean, once the note has reached its end of the life cycle. And when this is received, this is referred to honoring of notes receivable. Because a note is a promise, right? It's a promissory note. You're making a promise to pay whatever the principal was plus whatever interest both parties agree on. And so by paying back that amount, you're honoring your promise. Or payment is not received. Cue the Law and Order music. In which case, This is called dishonoring of notes receivable because you have not honored your promise. All right, so we're going to look at what the entries look like for honoring and dishonoring. So let's start with honoring. When the principal and interest rate are received at maturity, by the way, at maturity just means at the end of the note period. So if we took a note receivable for, say, 4 months, and then at the end of those 4 months we pay the note back plus interest, it means the note has matured. Well, actually, I should rephrase. The note matures at the end of the time period, whether it's paid or not. But yeah, maturity just means the interest is not growing any longer and the note doesn't get any older. It has matured. Okay, so when the note receivable is honored, we debit cash because we're receiving money, and we credit notes receivable. And we add a dash customer. Don't write customer, write the actual person or company's name. But yeah, it just means we're getting paid. And we credit notes receivable for the principal amount, no interest, and then we record the interest revenue separately. So that's the only real thing to keep in mind, is that the interest revenue is kept separate. And in terms of dishonoring the note, this scenario of dishonor can be broken down into two different paths. The first is the business, i.e. the payee, expects eventual collection. Or the second path, if I can find it here. Of course, it's not on this slide. If the business expects eventual collection, then they convert it back to accounts receivable. So they flop it back. And of course, my computer's hard drive was full, so I had to empty a whole bunch of stuff. Anyway, all right, so dishonoring of notes receivable. So one of two things can happen. If the business, i.e. the payee, expects eventual collection, then what they'll do is they'll shift it back to accounts receivable. Just because at that point they've followed procedure, they expect to be paid, and therefore a certain time frame is established. So what happens is there's just an immediate transfer from notes receivable back to accounts receivable. And so we just have a simple entry of debiting accounts receivable because it's still an asset because we expect to be paid. And so we just credit notes receivable to diminish the notes asset and transferring it to the accounts receivable asset. And it also, just the nature of having the label here for the customer whose notes receivable we are transferring to accounts receivable, it just lets us keep track of who's not paying their debts. So maybe we don't trust them so much in the future. And, because we still expect to be transferred any interest that was accrued on it, but since we have moved this to accounts receivable now, no more interest is accrued on it. So we write interest revenue even though we aren't paid that interest revenue necessarily right now. We're just recognizing it that we will be receiving that revenue within the period. And so the correct way to journalize the transfer from notes receivable to accounts receivable on a note that has been dishonored but we expect to collect is this. Okay, so the second option number 2, is when the business or the payee does not expect collection. So it is treated just like a bad debt, and any bad debt, whether it's notes or accounts receivable, uses up our allowance for them, right? So we have to make sure that we remove the $1,000. Since it's a contra account, we have to debit it to diminish the quantity that's in there. So we diminish our allowance by whatever the amount is, because that amount of allowance has been used up. And we credit notes receivable with the customer's name, because notes receivable is an asset and we are diminishing it because we don't expect to get that note back. Now, obviously, there's no interest revenue recorded at this time just because we're not getting it, right? And we only record interest revenue when the note is either matured, or there's an adjusting entry and we want to see, or or if it's transferred to accounts receivable. I was just trying to think of the third one. But since we're not getting any, we don't record anything else. And that is it. So there you go. Notes receivable. My God, I forgot how long these things take to make. Yeah, that's it. So that covers all the new material except for the last little bit about statement presentation. It's just half a page. So I figured it's just easier to read the half page. If you want a video about that, though, put something in the comments and I will do it for you. But yeah, that's it. So hopefully you guys are doing okay with the homework and stuff like that. And I will see you next week with a next video. All right. See you later. Bye.